Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. U.S. stock markets had their worst week since the March crash. Is this something to worry about, or is it just a minor correction? Ross also looks at Apple splitting its shares, gold, and the U.S. and Canadian dollars. Rick Ackerman, editor of rickspicks.com, gives us his take on the U.S. economy and what's been driving the stock market and what kind of fallout he expects no matter who wins the U.S. election. Author of the second edition of When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, examines the downturn in the Canadian economy and whether the national debt is manageable. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Good to be with you, gentlemen.
The last 2 days of the week on the U.S. stock markets, scary or what? Or just a little blip? What was the story there, especially with the NASDAQ?
Well, so far it's a big blip. I mean, here we are. A week ago, we got the first of our excessive readings on the NASDAQ, upside exhaustion readings. We also, and that was the first time that we'd seen it since February. We've been in rising channel. It popped through the top end of the channel. And, we knew if there was one of these upthrust failures where you overdo it and then fail, you'll get right to the bottom of the channel. The S&P was the same way. It had its first upside exhaustion readings in over a year. There was last Friday, Tesla and Apple got around to their splits. And we had put out a piece, and we talked about it last week, that whenever in the previous 4 times with Apple where they had a stock split, the stock had dropped off by 13 to 16% within the next 2 weeks. Well, as of now, we've had that break, and Apple had a pretty rough week. Tesla even as bad. They bounced back at the end of the week, but in terms of the downside, when you've had the excesses that we had, where, in the NASDAQ, 7 stocks represented a half of the total value of the index. The P/E ratio on the S&P 100, was in the top 99.5% of historical levels. The percent bulls, in terms of sentiment, you had 64% bullish sentiment, and that level is very, very high. It's always corrected after that. So, as of Thursday morning, everything started to come apart, and by the time we got to the middle of the day on Friday, S&P now has given back a 23.6%, which is one of the nice Fibonacci numbers. That's 23.6% of the whole run since March. It kissed its 50-day moving average, and on the modeling that we've got with previous analogs, this was a pretty good target for the first break. What we need to watch now is to see if this break ends up being an overbalance of price and time, in that the correction becomes longer and deeper than anything we've seen since March. If it starts to develop that way, probability is that this distribution pattern could take us right down into the election. So we're going to watch pretty closely in terms of the bounce that happens from the Thursday-Friday break. And personally, I would say that if you see it recover a third of the losses, that might be a place to look to be a seller in anticipation of a continued leg to the downside.
Ross, does the week of September 1st historically make investors feel nervous?
Well, yeah, this is, there are a few key dates historically that really jump out. And we've seen, September the 1st, 1929 was the high of the Dow. And it took until Elvis became popular in 1954 before that high was taken out. Just more recently, in 2000, Tuesday, September the 26th, was the top then, and we know what happened after that. That was the end of the dot-com bubble. And as the dot-coms topped out, the value stocks came back into favor for a number of months. But by the time you got to September, we were entering that historically seasonally weak period, and the markets took it on the nose. So the September-October period historically is a pretty, it's the time when markets tend to correct. So having been at excess levels, it's only natural that we're starting to see this right now. And as far as we can see, as I say, that 23% rate probably ends up being more than that by the time we're finished.
Apple split its shares. Does that make it a bargain for speculators, or is this kind of a warning sign that they're trying to suck in money that perhaps they shouldn't?
Well, it becomes a tradable low. Let's put it that way. We got a good oversold reading as of today. We look at a commodity channel index, the CCI 8. As we published a week ago, it needed to get down to minus 140 to become oversold. It was at 167 today. And we had corrected more than 16% off the high price. So it's a perfect place to get a decent bounce out of here. But Apple, after the bounce, it's probably like the whole market. It's in need of a much bigger correction. And it's, and we're seeing it pretty much across the board. We've got reversals in not just the equity markets, but if you take a look at the currencies, U.S. dollar was making marginally lower lows for the last month or so. It would make a low, rally back for 3 or 4 days, go down, make a marginally lower low and turn. We did the same thing this week. The reversal in equities was at the same time you saw the bottom in the U.S. dollar. Dollars bounced back to very short-term resistance, and if it starts to pop through these levels, then you could tack on another, probably 4 or 5% in terms of the currency. If that happens, then it fits into our scenario that we've been looking at on precious metals. The silver has just been true to form. The oversold a week and a half ago on the daily charts. We needed a rally that would take us back to the upper Bollinger Band and produce an overbought signal. We got that perfectly on Monday night, Tuesday's opening. Silver got up around $29. It backed off very hard into Friday. A little bounce towards the end of the day. We're oversold right now, so probably get a bit of a bounce. But with silver probably looking towards the $24.50 range before there's a decent support area as far as we can see. Gold's been holding up reasonably well, but I think that there's more to be seen on the correction here in the gold market.
Is the Canadian dollar surprisingly high right now?
It's not moving with the oil market. It's sort of put itself aside from that one. I guess a lot of that's because we have difficulty shipping out outside of our shores. But it has been moving very well with the agricultural markets. If we look at the DBA, the agricultural index, it's stair-stepping its way up, and Canadian dollar right along with it. At this point, Canadian's up around 76.70, and anytime you're in a trend as far as the currency is concerned, you want to make sure that you just watch support levels, and as long as those aren't broken, you stay with the trend until proven otherwise. Right now, we would say 75.90 is the key level for support on the dollar. And unless, the other item would be if we can see a divergence in the currency versus oil and versus the DBA, the agriculturals, that would be a negative. But for now, Canadians outperforming oil. Oil back under $40 at the end of the week here. So, trend is up for now and treated accordingly.
Ross, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at chartsbyross. Coming up, Rick Ackerman next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Rick Ackerman, editor of the newsletter Rick's Picks, his website rickackerman.com. He's speaking to us from the Jersey Shore. Welcome back to This Week in Money, Rick.
Thanks, Jim. Always a pleasure to be talking with you.
Rick, what's the latest at Rick's Picks, and how can people subscribe to your service?
Well, if you go to rickackerman.com and click on the trial subscription, $1 will get you 2 weeks of everything. You can go into the chat room, which I think is one of the best trading rooms in the whole world. Everybody sort of speaks the same technical language in there, the hidden pivot system, and access to the trading touts each day, many actionable ideas, great place to be. So again, rickackerman.com, just click on the trial offer.
Rick, do the U.S. stock markets look like they're ready for a major correction?
I am looking really at a couple things. I've kept a focus on Apple on the way up. I can read a chart. So I've been using a series of targets in Apple, but on the weekly chart, the kind of longer term chart, Apple ran out of room at 135.96. So I couldn't project anything higher than that. The other day, it took a stab, all-time high, a couple of bucks above that. And ordinarily, I think that just that overshoot is bullish, and it could be, but I'm open to the possibility that it's over, that the whole March 23rd forward buying hysteria is over, and it's because I've shifted my focus to dollar. The dollar over the last week has come down to a very major trend line, and it rallied from exactly almost to the penny where I'd expected. And as far as I'm concerned, if the dollar has embarked on a major rally, you better kiss everything that's happened since March 23rd goodbye, because all those trends are going to reverse. The crude's going to come down, stock market's going to come down, the FANGs are going to come down, interest rates are going to go up, gold and silver are going to get hit, but not as badly, because I think that they have a perception of underlying crisis that's going to keep them buoyant.
Are the stock markets a good predictor of the future economy, and what do you think they see?
Well, up to a point. I've always thought that it's said that the stock market's prescient, but I don't think if the stock market were a dog, it couldn't find a lamb chop tied around its neck, much less predict the future. But I think that the stock market, in going up and down, reflects broad cyclical mood changes, so that when the mood changes for reasons that are known only by the cosmos, the rally in stocks changes the psychology, which in turn enables the economic recovery. So I don't think the market predicts it so much as it influences it, but the market itself is simply a creature of cyclical movement.
What do you see ahead for the U.S. dollar, short and long term?
I think that the last thing that anybody in this world wants is a strong dollar, and I think that's exactly what we're going to get. Every time the dollar upticks, it means people who owe dollars are the burden of their debt is increasing, and that's the thing that the Fed has been trying to avoid, essentially a deflation. But it's taking more and more pumped-in money to even nominally support inflation. So the target of 2% inflation, you can forget it. As much money as the Fed can pump into the system, the larger black hole of deflation swallow it up. And to the extent that the money shot into the market or into the economy since March, April, May has gone mostly into financial assets, it can vanish overnight if stocks fall and housing prices fall, as I expect.
With gold recently hitting new highs, what do you see for the precious metal ahead in the short term and the long term?
Well, I like gold. I think it acts especially well when it's getting beaten down. This seems to happen opportunistically, like the bullies, the bullion bankers knock gold down, but only to buy it. And the sellers are having a lot of trouble pushing gold beneath certain technical thresholds. So occasionally gold will hit a rough patch and it gets hit pretty hard. But I think the basic trend is up. COMEX gold currently trading around $1,926, but I've got a target up there above $2,100.
What's your outlook for silver?
I like silver very much. My most immediate target there is, I believe it's $31, so there's a good room for upside. Silver currently trading about $26.57 basis the December contract. So I think silver is going to push back up above 30.
And in the long term, is it a good thing to hold?
Always. I don't think it can go wrong. And I say that as someone, I used to buy my gold and silver, junk silver from Trader Sam in San Francisco. And I can remember walking out at one point in my life with 2 bags I paid $16,000 a piece for. And then when silver collapsed, I brought the same bags back to Trader Sam, and he took them off my hands for about $2,800. So even with that experience, I can say you're never going to go wrong really holding a bag of junk, and also some gold coins, non-numismatics, or if you like, some of the gold eagles, which sell at times at very little premium over spot. So always a good long-term thing to have. Now,
what about the long-term? When you're holding gold, you have to worry about the cost of storing it. Are you better to have your own floor safe, or I guess it depends on the amount you're holding?
Well, we should all have so much. We should all be so fortunate as to have so much gold that it won't fit into our safe deposit boxes. But medium-sized safe deposit box, if you fill it up with Krugerrands, that's a lot of valuation. So the storage problem for most people is not really a problem. You can easily store it yourself, unless you're one of those people who piles up ingots in a warehouse.
Bonds and interest rates, could we be in for any surprises there?
I don't know so much about a surprise. It depends what you've been expecting, but I think that with this upturn in the dollar, we're going to get somewhat rising interest rates, and I know that goes somewhat against the popular wisdom that the Fed is just going to hold them down no matter what, but eventually the market is going to determine the rate for long-term bonds. So the banks have a little bit of play in the yield curve. They finally got some curvature to work with, but I do see over time on the long end an increase in rates.
Any thoughts on the Canadian dollar?
It looks pretty strong here, and I'm not really bullish on the currencies other than the dollar, but I would reserve judgment on the Canadian. It seems to be doing pretty well.
What do you see ahead for crude?
Well, that's gonna be one of those things that nobody wants really. Crude prices are going to come down, and the problem there is that so much of the borrowing in this world has taken place on energy collateral. So I think that a decrease in the price of oil is a part of that deflationary scenario that I've been talking about for so long. The powers that be have really tried to support crude in any way they could, but ultimately it's going to be a creature of market forces.
The real estate industry says the average house price has gone up. Does this make you bullish on real estate?
Not at all. I would say that nobody on planet Earth, nobody could have predicted in March or April that we would be seeing new highs in home prices. Even with the pandemic, when it started to come and we started to see a migration out of the cities, you still couldn't see it coming, really, that real estate prices in the suburbs were going to go bonkers. You know, I grew up in a little seashore town off the New Jersey coast, and I'm there right now for a little vacation, and prices in this little peaceful seaside town are going absolutely nuts because, you've got so many people fleeing New York City and Philadelphia. This is a big, big trend. This isn't a fad or a passing fancy. It's going to be something that goes and goes and goes for years, and it's going to put I'm not going to say a floor under home prices, but because in a way, there's kind of a paradox for me. I'm looking at deflation and a collapse in home prices. I see that as inevitable based on demographic reasons, if nothing else. It's a question of, are these millennials who are living in their parents' basements and trying to scrape a living with degrees in art history, are they going to be able to take over these $1 million, $2 million homes, even in California, where those are tiny homes in Southern California? So I see a collapse ahead for real estate prices, but I have to say that the intermediate term trend with this migration out of the cities has to be bullish for suburban home real estate.
What do you see in the cryptocurrency markets?
I think it's going to 14,000 and maybe beyond. I've had a long position for years in the cryptos that survived a stop loss that was a little bit below 3,000. So I think the technology of blockchain currency is it's pretty well entrenched now, and I think to the extent that it's useful, we're going to see a more or less a steady flow of money into the crypto. So it got hit really hard yesterday with everything else, but again, currently trading 10,433. I'm looking at least 14,000 on it and then higher.
Is there a push on for governments to get rid of cash and have their own controlled digital currency?
No, they've got enough control already. Just try to take a large chunk of money out of the bank. They don't need cryptos to control it. And I think it would paradoxically hurt cryptos if the government were immersed in it, because you would essentially think that Big Brother is there watching every transaction you do. And even though they are there in that way now, it would just be that much easier for them with cryptos. So I don't think the government wants to, the government can also regulate the banking system to the extent that there are all these plastic, the means of putting money in play through credit cards. So they don't really need a cryptocurrency, although it will come to have increasing use, perhaps even in government circles.
We'll have more with Rick Ackerman when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Rick Ackerman. Rick, President Trump has alluded that COVID-19 could go away on November 4th. Some people calling it a pandemic, others calling it a hoax. Whenever people are calling it when COVID-19's resolved, will it have a significant impact on the markets and economies?
Well, everything that Trumpster said is misconstrued in some ridiculous way, such as this what he said about testing the ballot by voting twice. But as far as COVID-19 disappearing, what he's saying is that the hardships that COVID-19 has visited on the U.S. economy and on our personal lives will be less useful to the Democrats after the election, which is to say after Trump wins re-election. And I think you have to agree with them to some extent that the virus has been used as a tool really for political ends, in many cases local political ends, but it trickles up into state and federal politics. So he doesn't mean that the disease will literally go away, but let's just say the exaggeration of the disease's threat will go away.
Is COVID inflation currently being seen in the stock and commodity markets?
Well, yeah. I mean, we've had all these support packages. It was mostly dead money. When you get your $1,000 or whatever, your check in the mail, it really supports your landlord, which in turn supports your mortgage holder, which in turn supports if the landlord's got a mortgage to pay too. So it sort of trickles up. But as far as having a big impact on the economy, I think it's overestimated, really. It's been somewhat exaggerated. To an extent, there's a little bit of kind of wartime spending there. We don't have as many things to be spending money on these days. So at a lower level, we're still spending with Amazon and buying stuff. But so let's say consumption levels are up, supported by, in particular by the middle class that hasn't been too badly affected by the virus, the people who work from their homes or, mainly those people, but also the ones who aren't working at all, who are still collecting more than they got when they were working. So actually I think that ended July 30th, but there's still some money jangling around from those multi-trillion-dollar support packages.
Have consumers been going deeper into debt since the COVID pandemic began?
No, I don't think so. I believe they have been retiring debt. There just aren't as many things to spend money on. Not the big ticket items, cars and houses. Well, houses are going gangbusters with that segment of the economy that can get mortgage money or in many cases pay cash for homes. But no, consumers haven't really been going deeper into debt. They will be buried by debt in the not too distant future, but for now, no, they're sort of stabilized.
I guess it really depends what segment of the economy you were in. The service industry hit really hard if you worked in hotels, tourism, the airlines, or cruise ships. But if you worked in an office and can work remotely, you probably are putting away the cash, right?
Right. But it's a big deal. I mean, when you look at New York and how only 10 or 15% of office workers are showing up, that really affects the ground level, all the businesses that operate, I guess you could call them the amenities of a city. So we haven't felt that yet in full, because a lot of restaurants are marginally open now because the weather's warm enough to serve outdoors. I'm in New Jersey. There's no indoor restaurant service, but everybody's kind of pitched a tent in the parking lot, so they're keeping alive just marginally. They're not exactly packed houses, but when winter comes, we're going to feel the full effect of that.
Do you think the U.S. is likely to see continued civil unrest for the foreseeable future?
Yeah, especially if Trump wins, which I think is likely. I think that the pollsters are they're from outer space, really. I believe that people just watch TV. They've got eyes. They see what's going on in this country, and they're not going to vote for more of it. So I really think Trump's going to win. and that's not exactly going to pacify Antifa and all the other lunatics out there. So I think civil unrest is going to be with us for a while, notwithstanding the fact that Trump is at this point campaigning as a law and order guy, and I think we can take him at his word. We're going to have civil insurrection in the cities put down with more force if Trump is reelected, and who knows, he may have some help from local voters if they have the good sense to dump the Democrats out of office and replace them with Republican mayors and county governance.
We're hearing Marxism is being pushed around the world. If it gains traction, what could happen to the markets?
Well, it's funny you should mention that. You know, I'm reading a book called Arguably, a collection of essays by Christopher Hitchens, and he was an avowed socialist, but not in the same way that people are claiming to be socialists now. You know, most of them, I would say none of them, have really read the books. But the socialism that Marx envisioned, he felt that it would take root best in the United States, where democracy and a republican form of government were developing. He didn't really see the dictatorship type communism that we've seen all over the world in association with Marxism in its ostensibly successful stage. So, but to sort of look at the reality of what's going on, I mean, the Marxism, or what people call Marxism, is just the simple part of it, of confiscating all property and wealth and apportioning it so that, well, as we've discovered, it no longer produces income. So that's still going to be very popular as long as you have haves and have-nots, and more popular to the extent that the gap between haves and have-nots these days has never been wider. So even though it's understandable what the rioting about out there and why anybody would advocate forgiveness of $1.5 trillion worth of student loans and free this and free that, it's simply a condition of despair on the part of many American citizens. They feel like they're never gonna catch up, and even the ones that are working know that they're never going to act in Social Security and Medicare what they're paying in right now. Both of those systems are headed into collapse. So I don't blame them for being disgruntled, although you have to draw the line somewhere. When the disgruntledness takes the form of violent looting and rioting, that's when you really have to, I guess, step on it, squash it.
What percentage of people do you think are free thinkers?
Maybe 5%. I mean, you look. I think that the number of people who are enticed by free thinking that happens on the web is a much larger number. But it's almost like a bad diet, you know. It's a hard habit to break, to truly think for yourself and to make decisions that go against the crowd, that go against the popular wisdom, but even go against the system itself. So the number of free thinkers who openly oppose the system, who say that you know, it's got everything wrong, that's a very small number. But the number of people who who let's say perceive the oppression of the system. I'm going back to Hayek's book, Road to Serfdom, a book that described how we would all become so encumbered by debt that we would have no freedom at all. We'd all be serfs to a banking system that seemingly has infinite money to lend us. So it's true in the way that Hayek predicted that we've all become so encumbered by debt that our options, the things that we would do if we were truly free, are limited.
What sectors do you like going forward?
I like anything that looks horrible now. You know, like cash for one. You couldn't do worse there, or by that I mean better, than short-term government paper. I think it's a good time to be sitting in cash. I also like maybe a 10 or 15% piece of it in gold, and a piece of that in speculative mining stocks, which someday may come alive. So you should probably have a bullion hedge, but with a good portion of your money in cash or near cash. I've been a bond bull for a long time, T-bond bull, but I think that we're entering a period where bond prices may come down a bit, and interest rates, if they don't rise, they're going to rise in real terms.
Where can people find out more about Rick's picks?
Well, if you go to rickackerman.com, it'll take you to the home page, and you can click on the trial offer button, and you'll have the opportunity to take a 2-week trial subscription for just $1. That will get you all of the services and features of Rick's Picks, most particularly the chat room, which I think it's the best trading room in the world right now. We've got traders from all over the world, and they are very generous as far as sharing real-time ideas. Just come in there for a day and see if people are actually making money based on the things that get discussed in the room. So this would also include access to my daily touts. This is a list of popular trading vehicles with often actionable advice for those vehicles, but a way to orient yourself to what's going on each day in the markets. So again, rickackerman.com, just click the trial offer button, and for $1, you'll get everything for 2 weeks.
Rick, thank you so much for being on This Week in Money.
Well, much obliged, Jim. I appreciate always a chance to get together with you, and I'm looking forward to our next chat.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. He was speaking to us from New Jersey. Coming up, Hilliard MacBeth, next on This Week in Money.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abnresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the book, the second edition of When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Hilliard, welcome back to This Week in Money.
It's always a pleasure.
Hilliard, how is the second edition of When the Bubble Burst doing?
Well, I think it's steady sales. I don't get reports all the time. I get infrequent reports, and but all the bookstores are still carrying it, which is pretty good after, including the first edition, it's 5 years now. And and I get inquiries almost, for sure weekly and sometimes daily from people who've read it asking me, when is the bubble going to burst?
We're seeing increased home and auto sales at the same time. Millions of people are out of work and on short-term government assistance. What's going on here?
I think it's hard to explain. It really is. It's one of those phenomena that is just we're on the borderline. Well, not borderline. We are in the worst recession since 1945, and we really have to go back to the 1930s to get anything comparable. Unemployment has doubled in Canada, it wasn't necessarily an extremely low base, and it's maintained a fairly high level of unemployment. The numbers came out today at 10%, but if you include all the people who've given up looking for work, unemployment is 13%. Well, there was no recession since 1945 that had anything like that high a number for unemployment. And so for sales to be booming in certain areas of the real estate market and auto sales, it's just incomprehensible. But so the one possibility is the fact that people are at home, they're not spending any money traveling, and they're getting a large amount of government support. The income support from government, especially the federal government, is greater than the loss in income from wages. So even though 13% of the people are unemployed, in a sort of a rough summary, they've got more money to spend than they had before, and they've got more time on their hands to spend it because they don't have to go to work.
Are people using low mortgage rates to refinance their debt and spend money on cars and vacations?
I think that certainly the mortgage rates have gone below 2%, and that's obviously much lower than before. In Canada, it's a little bit harder to refinance without paying a big penalty. So I suspect that it's not as big a deal as it is in the U.S., where the mortgages are for 30 years. So the penalty in the 5 years. So there's a certain amount of mortgages come up for renewal every 5 years, and so there's mortgages all the time renewing, and they're benefiting from the lower rate. But I think the savings rate is skyrocketed, so I don't think that people necessarily would be refinancing to spend more money. They might be paying down their mortgage with all this extra cash they've got sitting around.
What's likely to happen to real estate and the car market when this temporary government assistance ends?
Well, we're going to find out soon. It's the mortgage deferral is the big one, because something like, depending on whether you're in Alberta, where it's 20%, and then Ontario, I think it's more like 10% of all the mortgages are in deferral, which means that you don't have to pay your mortgage. So obviously you've got, $1,000, $2,000, $3,000, $4,000 a month extra to spend. That ends 6 months after the deferral was granted. So also auto loans, credit cards, all of the various consumer credit items can be in deferral. And many, many, many people have all of the above in deferral. So when that ends, which is happening, most of the mortgage deferrals end in October, which is just 3 weeks away. There will be we'll find out who is actually able to pay their mortgage and who is not able to pay their mortgage. And the banks have put out optimistic numbers, but we're going to find out that there are a significant number of people that are in trouble, and without the mortgage deferrals, they would have defaulted. And so we'll see what happens. There doesn't seem to be any indication from the regulator, OSFI, or the government, or the banks, that these deferrals will be extended. So there's going to be a hard stop to the deferral coming in October, and I'm sure that that'll be a big change in the system.
Do you think a significant portion of deferrals are just people who thought, this is a great chance to not pay the bank and pay myself over these few months so that I can actually build up a savings account or a little slush fund to look after household repairs?
There could be a number of them, but I suspect that a lot of the people that are heavily in debt, and that's, there's a significant number of Canadians that are, I remember you and I talking 6 months, a year ago about a report from Equifax that said that something like 40% of all Canadians are $200 away from being in trouble if they lost their income by $200. So those people, I don't think they would apply for any kind of deferral because people that are heavily in debt are very wary of their credit rating. And even though at the time these deferrals were announced, it was stated by somebody that it would not affect your credit rating, I think most people would be reluctant to get on a list of people that ask for a deferral. Because it might affect their credit rating. So I suspect that the majority, something like 95% of them, really could use the help. And we can see that in the unemployment numbers. There is a rebound in employment, but we're still missing a very large number of people who haven't been able to get back to work, and many of them have given up looking for work. So some of those, probably most of those, had some debt, and we're going to find out fairly soon how they deal with that.
When the coronavirus scare ends, either on its own or with a vaccine, are we likely to see real estate activity pick up on the buy side or sell side?
So I think it depends on when it ends. So if the coronavirus scare ends in, like some people in the U.S. are talking about by the election on November 3rd, I think Dr. Anthony Fauci said, be ready to have a vaccine on November 1st. Then I think you'll see that people maybe will be fairly enthusiastic to go out and start spending again. However, that's extremely unlikely. A vaccine needs to go through trials. If they rush out vaccines that haven't been tested, and then there's some negative side effects, which is what's happened in the past with previous attempts to get a vaccine, that's a huge setback, because then the vaccine has to be pulled off the market. A whole bunch of people, are now would tilt over into the category of I'm not going to take the vaccine. And vaccines don't work if a large number of people don't take it. I think it's something like 70 or 80% of the people need to be vaccinated before they work. So it's likely to be a long drawn out affair. Some experts that I've read and listened to are talking about a minimum of 3 years, 36 months from February. So that would mean, in that case, the real estate activity would probably not be affected if it drags out that long.
Is housing inventory lower than usual, and what are we likely to see going forward?
Well, it depends on which category you talk about. So, single-family homes is the big boom. There was an announcement this week about a big jump in sales, 20% or 40%, depending on where you're talking about. But almost all of the jump has been in the single-family homes. Like people want some land, they want a backyard, they want because they're spending so much time at home. And on the other hand, listings for sale of condos in Toronto and Vancouver have skyrocketed. In one area it's over 100% increase, in another area 66% increase. So this is a completely different market. So there's no shortage of condo listings, and quite a few of the condo listings are also listed for rent, and rents are coming down very fast. Like what used to be $2,200 a month in Toronto is now $1,500 a month, and so on. So that's also, by the way, happening in San Francisco, New York, and in Australia as well, where there's expensive real estate markets. So I don't think the shortage of supply thing applies, except maybe with single-family homes. And obviously in the big cities like Toronto and Vancouver, they tend to be outside of the core center, more in the suburbs. So there's a bit of a surge in activity in the suburbs, and so there may be a shortage of housing where you could have a lawn to cut, barbecue pit, or whatever people want.
Well, after you've been in a 450 square foot condo in Vancouver, having a backyard seems pretty attractive.
Yeah, that balcony that just barely has room for your bicycle and maybe a hibachi. If people can remember what a hibachi is. That just doesn't cut it, does it?
Is this a major trend, people moving out of crowded cities out to the burbs and even small towns or rural properties?
Well, so I got into a bit of a Twitter flare-up. By the way, people can follow me on Twitter at HMACBE, and there's quite a few good discussions going on. Some of them are not so good, but most of them are really good. And one of them was a comment I made about suburbs. So suburb living, as people realize, is there's a lot of automobile driving involved, because wherever you go in the suburbs, you have to get an automobile to go there. Was my experience in my experience of living in a suburb. And I got really tired of it, and we moved back to the close to the core of the city. So people, but as was pointed out in the Twitter flare-up, I wasn't taking into consideration the work from home situation. So if work from home becomes a permanent shift, then why not? Like if your home is 30 miles out of, or 30 kilometers outside of the city, or 40 kilometers out, you could still come downtown in say 45 minutes or an hour. But if you're only doing it once or twice a week, it's not that onerous. And so if the work from home thing is permanent, which it could very well be, then there could be a major trend. But I think it's exaggerated. Now, for one thing, all these listings of condos for sale and for rent, most people don't have the money to buy a suburban home or a rural acreage home without selling whatever it is they currently own. Often it's a condo. So the amount of people that can actually run out and buy in the suburbs and still hang on to their property in town is very limited. And so if they can't sell, they can't buy.
Do developers tend to continue building into housing downturns?
Absolutely. This is one of I remember this clearly from 5 or 6 years ago when I got involved in this in the beginning. I was talking to a lawyer in Toronto, and he said, well, don't the developers realize that they could overbuild, or there could be a bubble bursting, and they could get stuck with all this inventory. And this fellow who had been involved for 40 or 50 years in real estate development said, you know what, builders just keep building until they go bankrupt. That's as long as they can get financing, they'll build. But you think about it, they got a property, maybe a downtown property, they have an option on it. They get the permits, they get the city zoning, they get the down payment amassed from their friends and investors and stuff. Then they go to the CMHC financing, and CMHC's got a really good offer on right now because they want to encourage, multifamily building. It takes maybe 3 or 4 years to get all that lined up. And then they're ready to go, and they've got the financing. Well, they're going to go ahead. They don't care if it's a recession or if it's like there's a surplus of apartments, which there is. They're going to go ahead because they've been working on that project for 3 or 4 or 5 years, and so yes, they build until they go bankrupt. Is what they do.
Could Canada be in for a deep recession, or what they may have referred to in the past as a depression? And by the way, what's the difference?
So this is a really good question. There is no technical definition. There isn't even really a technical definition of a recession. It's more of a subjective thing. So the definition everybody sees of a recession is 2 consecutive quarters of negative growth. So we obviously had that in the quarter in Canada ending March 31st. There was a small drop in activity of 1.5% or 2% or something. And then in the second quarter ending June 30th, there was a huge drop in activity of, I'm going to get these numbers wrong, but just say like 7-8% or something. So a total of 10% over 2 quarters. Unprecedented, by the way. You have to go back to the 1930s to have that big a drop. So that's obviously a recession. And how bad was the depression in the 1930s? Well, it was like at 20%. So it was basically twice as bad. So if you want to say, could this be a depression? Well, it's not there yet. We'd have to have another quarter. Let's just throw out a number. Let's say another quarter of 5% drop in activity, and then the total would be 15%. I was looking at a list of countries in the world who have had declines year over year in activity to the end of June. And Canada is in the double digits. I think Canada was like 13%. Australia was 7.5%. And there were some other countries worse, but Canada was one of the big ones among the developed countries. The United Kingdom was at the very top, I think, of 20% decline, which is unheard of. So you could call it a depression, or you could call it a very severe recession. It's certainly not anything that anybody alive today has really experienced before, other than if they were old enough to be in the Great Depression. And there's no technical term, so I don't think they'll call it a depression. I think that word has been saved for the 1930s. In 2008, 2009, they thought that was pretty bad. And by the way, the drop in GDP in 2008, 2009, which triggered the global financial crisis, was 4%. So we're already double or even triple, depending on which country, the worst previous recession since the Second World War, which was 2008, 2009. So when do we start calling it something else? Well, I don't know. It depends. Obviously, it'll be called the COVID-19 recession. They'll have to probably come up with a new term. But if listeners are interested, I really enjoyed reading a book called Diary of a Depression. I think the author's name is Benjamin Reaugh, and it's a little bit hard to find. But this is a lawyer in Youngstown, Ohio, who kept a daily diary of his observations as he went in the 1929, 1930, 1931, 1932, throughout the period. And then the editor's gone back and sort of selected certain things that were happening and said, made comments on that. Of course, the original diary keeper has long since passed away, but his son brought the book out. So it gives you some idea. And one of the things that really stuck with me was when you're in something big, like the 1930s, people tend to think of it as going to end soon. And of course, that one lasted 1930 to 1938 or something like that. So 8 years, and there was massive unemployment and all kinds of things happened. So what they do early in the downturn is they start to speculate on land and speculate on stocks and all that kind of stuff, thinking that the things it's been going for 2 years now. It must be over, right? So and then it turns out it lasts much longer. So it's quite instructive. And so I think people would be wise perhaps to consider this recession, depression, whatever you want to call it, as something very unusual. And that means changing behavior to anticipate the possibility that it might last 2 or 3 years rather than the average, by the way, is of a severe recession is about a year and a half.
We'll have more with Hilliard MacBeth when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, are we likely to see the price of housing drop into 2021, and what kind of percentage drops would we be looking at for the high-end, mid-range, and low-end homes?
Well, so you've got two things. You've got the date and the amount of the drop. So I was advised at the very beginning of this 5 years ago to never give both. You give one or the other, but not both. So, but it certainly looks like we're 2021 with the depth of this recession that we're going to see some price declines, and we're already seeing price declines in certain segments of the market, and yet other segments of the market are appreciating. So I would like to give people one warning though about house price indexes. I didn't know this, and it's kind of an obscure thing, but it's very important. The people that put out the house price indexes are unable to adjust for the improvement of a property. So, for instance, a house that was a teardown was bought for $500,000. Somebody buys it, splits the lot into two, and builds two brand new infill houses in Edmonton. They call them skinnies, and they spend so the land underneath that skinny is $250,000. They spend another $700,000 on a new 2-story skinny home, and they try and sell it for $1 million. Their cost is $900,000, and they try and sell it for $1 million. And when it sells, probably not at $1 million, but when it sells, it looks like that property increased in value from either $500,000 or from $250,000, because when it was a tear down, the building was worth $0, to something close to $1 million. And so if the mix of sales, so we talked a minute ago about the changing mix between condos and single-family homes. If the mix changes from a lot of older homes where the building is worth $0 to a lot of brand new homes that have been built or upgraded with substantial renovations, it looks like the price of housing is going up. But in reality, that increase was really just somebody spending money on building a new home or doing a substantial renovation. So the indexes are flawed, and therefore it would be hard to keep track. So one of the things that would be great, and I think in some provinces like British Columbia, somebody keeps track of it, is the price of land. So you can see, well, when the price of land goes down, then that's a significant sign that there's a housing price correction going on. So don't get fooled, especially now with the boom changing from condos to single-family homes. Single-family homes obviously are twice as expensive as condos on average, at least. So you might see from the real estate industry, oh, prices have gone way up, but really all it was people just changed the type of unit that they're buying. But back to the question, in 2021, late 2020, 2021, all of the elements that were the worst case scenario that was put out by the Bank of Canada in May of 2019 in a paper they published have been achieved. The increase in the unemployment rate, the peak unemployment rate, the drop in GDP. They had a worst case scenario, a very bad recession, close to a depression kind of thing. We've already accomplished all three of those. The only two that are remaining, they assumed a 40.9% drop in house prices. Obviously that hasn't happened. And they assumed that the recession would last 7 quarters. So they assumed a recession slightly longer than the worst recession, which is 6 quarters or a year and a half. Obviously we won't know. We're only about 3 quarters into the recession now. So we've got another 3 or 4 quarters to go. But I think it's quite likely that we'll we'll already clear that we'll probably achieve that. So that only leaves one if you follow that, which is the drop in house prices of 40.9%. Interestingly enough, the Bank of Canada staff economists assumed that mortgage defaults would not go up very much, even if prices dropped 40%, which I would take issue with. I think most people, Canadians have a long history of paying their mortgages, but in a recession like that lasts a year and a half, 2 years, and a drop in employment and an increase in unemployment, the likelihood there will be a significant number of people that default on their mortgages is extremely high. And what that is probably what it will take to get the prices to drop 40%. It would be a significant number of people defaulting on their mortgages, which is very un-Canadian, as you know. They'll default on everything, the car loan, the credit card, everything, but they won't, they'll try and hang on to their home. But if things get bad enough, if you're unemployed, there's nothing you can do. So that's what we are likely to see, I think, is a big increase in defaults after the mortgage deferrals expire, and that's in October, as I mentioned earlier. And then we'll see. We'll see how far prices come down, but my prediction is they will come down by quite a bit.
Are banks continuing to be conservative in lending?
Well, to use the term conservative lending in banks in the same sentence in Canada doesn't make any sense. There's no such thing as conservative lending in banks because they are protected from their very close alliance with the government from the consequences of their aggressive lending. So up until recently, they've been very aggressive in their lending. And then, of course, there's other companies like Home Capital and Equitable Finance that have a business model that says if the bank turns you down, then come to us and we'll take care of you. So there hasn't been conservative lending up until recently, but now there is. And one of the problems is, of course, when do the banks start looking at people's pay slips and wage packets and start questioning whether that job is going to last? So up until recently, people just said if you could show 2 years of income of $100,000, let's say, combined in the household, they would easily lend you $600,000-$700,000. If they start questioning whether that $100,000 income is going to last, then everything changes. For instance, what if they start questioning whether the schools are going to remain open or the daycare is going to remain open? So if both people are working, they're going to start wondering, well, what if one of you has to stay home because the kids are at home because they can't go to school because of COVID? So the conservative lending, if it isn't here yet, it's probably coming, but there hasn't been much in the way of conservative lending up till now. The mortgage growth rate continued to be extremely strong up until the recession started, and it's mostly because the government insurance program called CMHC protects banks from the losses. If they happen to be too aggressive in their lending, as long as they can buy the insurance or the home buyer can pay for the insurance with CMHC or one of the other private insurers, the bank doesn't take any loss. So the bank doesn't care. It just carries on. As long as it meets the rules that are laid out by the regulator and by the CMHC, then they're happy to lend the money. And so we'll see conservative lending before this is over, but we haven't seen it yet.
Are people likely to find out their friendly neighborhood banker is not as friendly as they thought?
Well, exactly. That's exactly what's going to happen. People are going to start to find out. Like you say, for instance, if the bank started questioning the jobs, you say, well, what kind of job do you have? Are they talking about layoffs at your work? What if one of you has to stay home? It was 40 years ago, which seems like a long time, but it is in a human lifespan, but it's not a long time in the history of banking and mortgages. 40 years ago, they wouldn't count both incomes. So they would only count half of the second. Well, initially they'd only count one income, a very sexist kind of approach, assuming the woman would stay home and have children. And then they started counting half of the second income. And then when they needed more buyers to keep the real estate boom going, they decided to start counting both incomes fully, which is pretty optimistic, I'd say. So if that goes backwards, or anything like that goes backwards, where did you get your down payment? what other borrowings that, they can sort of see if you do borrowings through the credit card system or the car loan system with the credit report. But there's other sort of informal borrowings that go on that don't show up on any of those reports. So they can start quizzing you about that. But, when they're in the sales mode, up until recently, they were willing to be fairly flexible and all of that stuff, as long as they met the core rules. We could start seeing very different maker in some areas. Like Alberta would be a prime area for that, because Alberta has 20% deferrals, much higher deferrals than other provinces. What they did in the 80s, which I thought was pretty interesting, was they actually changed the people. So the banks sent out new people, often from Ontario, to Alberta, with more of a let's collect the debts right away attitude, and the salespeople that had been in place up until then were all transferred or let go, because the sales type people have trouble saying no. So they found people that are good at saying no, and that would be a real shock to people today if those kind of nasty, tough people were put in place.
Well, according to the TV ads, they're nothing but buddies who hang around in desks and swimming pools. Staying away from politics, with the U.S. presidential election just 2 months away, what do you see ahead for the U.S. stock markets and economy, depending if President Trump wins re-election or if Joe Biden's elected?
So it's a very good question. So it appears that the stock market likes Trump better than Biden. However, the stock market rally continued up until this week. We finally had a significant sell-off on Thursday and Friday of this week, but the polls have been showing that it's quite likely that Biden will defeat Trump because Trump's ratings. So Trump's ratings before, going back a couple months, were around 43% or lower, and there's never been a presidential candidate seeking re-election that got reelected with a poll rating below 43%, and so at least not in recent memory. So the people that lost, Jimmy Carter and George Bush Sr., going into the second term, were at that level or lower, and the people that were reelected, like Barack Obama and George W. Bush, were higher. Now, George W. Bush was lower than that, and then in the last few months, just before his reelection, he picked up about 43%. So Trump has been consistently at 43% or lower for many, many months now. So if he is not reelected, then Biden gets in, obviously. And Biden's attitude towards the economy is very different. So if you look at his platform, for example, he's got a tax increase for corporations, a significant tax increase from 21% to 28%. Now that just puts it back to where it was before Trump cut it, but it still presumably is a big negative. An increase in personal income tax about $400,000. Not a huge increase. I think it's about 2% on the amount over $400,000, 2.5% maybe. And then a social security tax, which is kind of like the entitlement programs will be made sustainable by making both the employer and the employee pay a total of, I think it's 12.5%, and that's a big change. So those three things would be probably considered a negative for the stock market, because some of that all of the earnings per share, which is what the stock market multiple is based on, are calculated after those increases would be deducted. So earnings per share would decline by some number. It's a little bit puzzling, but I think the other thing to recognize is that regardless of those things, the first year of a 4-year presidential cycle, especially when there's a change, if it were to change to Biden plus a Democratic Senate, and of course the House of Representatives is already Democratic, it's generally the worst performing year of the 4-year cycle, the first year, because that's, makes sense. If somebody takes over new, they tend to, it's in their interest to sort of do all the nasty things in the first year, and also to blame the predecessor and say, wow, look at all this stuff that was done, and like, I was just shocked how bad it was. I had to clean it up, right? So try and make the predecessor own the difficult situations, and of course that's what would happen in this case. So the stock market's going to be set up for a poor performance in the first year of a new presidential mandate. In any case, even if it weren't for this unusual situation where stock prices are close to record highs, and we're in the middle of the worst recession since the 1930s.
How big could Canada's debt bubble get and still be manageable?
So Canada's debt bubble, usually when people use that term, I know from experience, they're talking about the government debt bubble. So they're talking about the federal government. So the federal government had a debt that was very manageable up until recently. It was around $600 billion. And now, as everybody knows, the deficit this year alone is going to be over $300 billion. So that puts the total federal debt up to $1 trillion, which sounds like a lot of money. You know, people know that $1 trillion is a very large amount of money. But the GDP is $2 trillion. So it's only 50% of GDP. The United States, for example, is 80-90% of GDP before the recession. I'm sure it'll be well over 100% of GDP after the recession. France is over 100% of GDP. So Canada was actually the best of the, some people would say the head of a failing class in terms of having the lowest debt to GDP ratio prior to this recession. And of course, we don't know what's going to happen after the recession, but obviously it's going up. The bigger item, which doesn't get much chatter, is the private sector debt bubble now. So in the government debt, Canada's in good shape. In the private sector debt, Canada's in the worst shape of all of the developed countries. So the private sector debt bubble in Canada is 220% of GDP before the recession started, and so it's over $4 trillion. So going back to, I said, federal government $1 trillion, private sector debt bubble over $4 trillion, $4.4 trillion, and that was before the recession hit. So it's 220% of GDP, and so that is the scary thing. So about half of that is household debt, and about half of it is corporate debt, and that is the debt bubble that can't get much bigger. It's sort of at the limit. Obviously, households can't really handle any more mortgage debt. They probably can't even handle the mortgage debt they've already got because of the unemployment rate going up so high. And corporations, we're already seeing a record number of bankruptcies. We would have a bigger record number of bankruptcies if the courts weren't closed to a large degree, and therefore access to a court hearing is difficult to get. But so I think the debt bubble is in the process of bursting as of today.
Any opinion on Canada's new finance minister?
So I think what happened there was, and I think it's been reported, is that the previous finance minister was against providing more income support. He's much closer to the business community. He was probably talking to the business people that he knew about people staying home from work because they were getting so much income support that they didn't have to go to work anymore, and they were making more money staying home. And Chrystia Freeland, the new finance minister, was more inclined to say, we need to help these people because they're out of work and they're literally on the edge of starvation. The two extremes. And so the change was made, and obviously the government has decided to go with the more concern for the average working Canadian and less concern for the corporate elite. And so Morneau is out and Freeland is in, and we'll see what happens.
In Alberta, we're hearing all kinds of action from people who either want to form their separate nation with Alberta, Saskatchewan, maybe Manitoba, BC, maybe even have Alberta join the U.S. What are you hearing about that?
Well, you heard a lot about it before this recession hit. Now, I haven't heard as much lately, but recently I heard that the Premier, I guess he would become the Prime Minister if Alberta was a separate country. The Premier, Jason Kenney, is now under criticism from the people that want to separate because he's not hardline enough. Like, he took a fairly hard line when he first got elected. But of course, the Alberta government debt now is totaling $99 billion. And the deficit for this year, there was just an economic update a couple of weeks ago, was $24 billion. So Alberta's going to need help from the federal government, because they're either that or bringing a sales tax, because of the dire economic straits in Alberta. The situation in Alberta is quite a bit worse than the average across Canada because of the double whammy of the oil industry collapse plus the COVID-19 recession. So I think in the government circles, there's going to be a lot more talk about cooperation, and And maybe the separatist people, they're not going to go away. They're going to be there, but I think they may get less attention. Little interesting factoid that most people probably don't know, and that is that in the Great Depression in the 1930s, Alberta was the only province to default on their debt. So every other province probably would have defaulted. There was a real serious lack of revenue for provincial governments. But the federal government helped all of the other provinces. But there was a fight between the federal government and the provincial government in Alberta, and the terms, of course, the federal government was willing to help Alberta to avoid default on their bonds, but the Alberta government refused to agree to the terms. And therefore, the Alberta government bonds defaulted. To this day, since 1867, they're the only significant default in government debt in Canada of any jurisdiction. And but it was great for people that had money in the 1930s. I don't know. I think the default probably happened around 1934. By 1938 or 39, the interest on the bonds was being paid again, and the maturity of the bonds was fully recognized by the government. So, but there were people selling their Alberta government bonds for 10, 15, 20 cents on the dollar because they needed the money, or they just wanted to get out. So what a bargain for people that had the foresight to buy up those bonds when they were so heavily discounted. But so is there a repeat coming? Maybe. I mean, if Alberta talks about separating, and the federal government's not going to bail out a province that's about to separate, so we'll see. What is happening in the oil patch right now? Things are pretty grim. I'm not that close to it. Most of my clients are not in the oil patch. Our investment strategy, going back more than 5 years, 2014, we basically exited the oil investments in oil in Canada and elsewhere. We had one investment in the U.S. for a while, and we got rid of that in the oil patch. We felt that the shale oil in the U.S. was booming, and it turned out to be correct. And Alberta was going to struggle, and that turned out to be correct as well. So we're not really keeping close tabs on it. But just to give you some idea, everybody knows this stock market boom that's happening with tech stocks in the U.S. The gains are like 100% or something. Well, over the same period, energy stocks are down 30 to 40%. So it's been a huge discrepancy between the oil patch in the stock market and the better segments of the stock market. And most of the companies in Alberta are still alive. A few of them have gone bankrupt, but their share prices are down. I was just looking through a few of them this morning, and almost all of them are down at least 50%. Several of them are down more like 60, 70% from 5 years ago. One company, Canadian Natural Resources, is trading about the same level as 5 years ago, which is odd, but almost all of them are way down. So there's very little capital and spending. To give you an idea, the normal revenue for the Alberta government from the royalties and income from oil and gas is about $5 billion a year. And in the economic update just came out 2 weeks ago, that number had dropped to $1 billion a year. So the Alberta government's making almost no money off of the oil and gas industry, and that's probably because the oil and gas industry is also making almost no money. How do you think the Canadian dollar will do against the U.S. dollar? So we've been wrong on this. So we were expecting a Canadian dollar in the 60 cents, 68, 69, 67 cent range, and we would have expected it would have happened by now. And that was based on the bursting of the housing bubble plus the collapse in the oil industry, which are two very important segments for the Canadian economy. But what happened is the U.S. dollar also collapsed. So because when we think about the Canadian dollar, we always think about the U.S. dollar, and the number of 76 cents, which is where it is now, is against the U.S. dollar. So the U.S. dollar dropped significantly, went from like less than around 105 to the euro, is the U.S. dollar, to 120. So the U.S. dollar dropped roughly 15% against the euro. The Canadian dollar dropped also by a similar amount against the euro and the Japanese yen. So even though our Canadian dollar came down a lot, it didn't come down. It actually went up a little bit against the one that we talk about all the time, which is the U.S. dollar. But we still think that the Canadian dollar will go down into the 60 to 70 cent range against the U.S. dollar. And what it looks like now that'll happen when the U.S. dollar goes back up again if there's some kind of a sell-off risk assets. So the U.S. dollar almost always goes up when the stock market drops or when other scary things happen in the world. Even if the irony of it is, even if the U.S. is the cause of it, as it was in 2008, 2009, the cause of the global financial crisis, the U.S. dollar still goes up because it's the only real safe haven that people know. They don't like their own currency anymore. I think that'll eventually change, but I don't think we're there yet. I think we're probably 10 years away, at least. The U.S. dollar will still be considered the benchmark, and U.S. government treasuries will be considered the safe assets. So when people get scared, they move into that, and that's when the U.S. dollar go up, and the Canadian dollar then will go down.
Are you keeping an eye on gold and silver?
Well, absolutely. Gold is a huge winner for us this year, and not the gold itself. We haven't bought the gold bullion or the contracts, the ETFs that what we like to do is buy the individual companies. So we own 4 of them, and they've gone up not as much as our some of our stocks, but they've gone up very, very nicely. And of course, the gold price has gone from $1,000 to $1,900, so a 90% increase in the gold price. And of course, the shares, when gold price goes up that much, usually the shares go up even more, which is what happens. So we like it. We still like it. We don't, again, even though it's priced against the U.S. dollar, so, maybe the gold bullion price won't go up a lot if the U.S. dollar firms up again. But the gold mining shares are extremely cheap. So what happened, going back a little ways, is in 2009, when the stock market sold off by, more than 50%, the gold price went up. And 2011 was the peak in the gold price. But the gold mining shares did not go up. So, because they decided that they were in the stock market, they weren't in the gold market, right? So people sold off the gold mining shares just as much as they did the other stocks. And so people got really disappointed with the performance of gold mining shares. And so now they trade, even after the rally, they still traded a very significant discount to the historical relative price to the gold bullion price. And so there's still lots of leverage there because there hasn't been a significant discovery of a gold mine in 10 years, at least 10 years, in anywhere in the world. So that's all it would take would be one significant discovery, and then people will say, oh, I want to get in on that. I want to get in on the leverage that's involved in finding new gold mines.
Is China likely to buy up Canada for pennies on the dollar?
I don't know. I think China, you talk about China, of course, you mean the government-backed corporations like the big banks. People don't realize, but in the top 10 banks in the world, 5 or 6 of them are Chinese banks, and they have a tremendous amount of clout because they lend all over the world. But they tend not to focus as much on Canada. I think individual Chinese people trying to get their money out of China have focused on Vancouver real estate and Toronto real estate, for example, even Edmonton and Calgary real estate, but to a degree. But the government has been focusing its efforts on things like the Silk Road and huge involvement in Africa. I haven't studied it closely, but I read about it all the time. Investments all over the world, Australia. So Canada will get its share, but Canada isn't as important to China as, and they're kind of mad at us right now because of some political issues and the arrest of chief financial officer of Huawei and things like that. So I would suspect that, and also when the Chinese corporations, which are usually connected to the Chinese government in some way, at least in some cases they are, when they try and buy a major Canadian corporation, they have to go through this approval process, which is very difficult and long, and now less likely to be approved than it was maybe 5 years ago. So I think it would be difficult for China to buy up Canada.
Tesla stock did a 5-for-1 forward split and then ran up to over $500 a share. Do you think this is increasing the value of Tesla, or just a way to suck in uninformed investors into what they think might be a safe share to have?
Well, one of the things that's happening with Tesla is that next week, September the 7th or 8th, I guess, or the 8th is when the S&P will announce their makeup of their index. So the S&P 500 has 500 companies. Tesla's market cap now is in the top I don't know, 10 or 20 companies in the world. And it's been profitable for 3 or 4 quarters in a row, which is sort of makes the requirements for the S&P 500 index inclusion. So it's quite likely that the split was related to being included in the S&P 500, and that announcement may come as soon as Tuesday next week. So the other thing is an awful lot of people that buy a Tesla car, like I did, also buy the shares, like I did. I just wish I'd bought more shares, but I bought some, and so they want to keep it affordable. But unfortunately, it became clear in the announcement that some people actually thought that the price, which had been $2,000 a share, was now $500 a share, so it must be a bargain. And they're sort of $400. When it first split, it was $400. It immediately ran up to $500, possibly because people didn't realize that it had split. And then now it's right back down to $400 again because of the sell-off this week. So I think Tesla's overpriced, but even the CEO, Elon Musk, said it was overpriced about 6 months ago, at a much lower price, by the way. So as probably all of the U.S. Leading big cap stocks are significantly overpriced, like Apple and Microsoft and Amazon. However, in the long run, Tesla will probably do extremely well. So I wouldn't buy any more at this price, but if it comes down, when I bought my Tesla, it was about 5 years ago, I remember the share price was around $170, and then it ran up immediately to about $300. So that would be the equivalent in today's terms of $70 or $80. So the run up, I thought it was too expensive at that time, so I didn't buy as much as I normally would. But so it's got a long way to get down to where it was 5 years ago. Probably never will, because they've progressed a lot as a company. Profitable, building factories in Texas, Germany, and China. So soon they'll have 4 factories up and running, and huge surge in electrical vehicle sales. But good investing still involves checking the value that you're getting when you buy, and buying today is assuming that there won't be any hiccups in the near future with Tesla, which is unlikely. They'll run into some setbacks, and that would be a better time to buy the stock.
Is it true Tesla is the most shorted stock in history, something like $20 billion worth?
I think at one point it was. I can't imagine that there's any Tesla shorts alive anymore. There was this whole, some of the short sellers in the U.S., the famous ones, I've gotten to know quite well because of my book about the Canadian housing bubble bursting, because they were also very interested in shorting the Canadian housing bubble. And some of them got involved in shorting Tesla stock, and I haven't heard anything lately from any of them that were doing that. Some very big names like Jim Chanos and others, Mark Cohodes, so they got killed, and they must have covered their shorts by now. There'd be financial ruin if you short a stock at $400 pre-split and it goes up to $2,000. The margin calls would have been just too large to be able to handle. So probably the short sellers have all covered their shorts, or they're bankrupt. So I think now the amount of short sales on Tesla is quite a bit lower than it was.
Where can people buy the second edition of your book, When the Bubble Burst, Surviving the Canadian Real Estate Crash?
Well, they can buy it online or at their favorite bookstores, or they can buy it on the Kindle or the e-reader platforms in both Canada and the U.S., Amazon.ca, Amazon.com, Chapters, Indigo, all those places. And the second edition, I added in a whole bunch of new material about what I learned since the first edition came out. Chapter on Japan, more information on Australia, chapter on how the economic theory completely missed the likelihood of a bubble forming and a bubble bursting and the economic damage that it causes. So I'd encourage people to have a look at it, because it'll help them survive this the next phase in this housing boom bust cycle.
Hilliard, thank you so much for being on This Week in Money.
Thanks for asking me to be on This Week in Money. It was a pleasure.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, macbethmcleodgroup.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Rick Ackerman, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Thank you, Jim. It's a long weekend coming up, so this is a good show.
Larry, I saw a tweet from your company saying that the pilot project for recycling is going great guns. Can you give us some details?
Yeah, that's exciting. We've increased the capacity on the pre-leach process to 292 kilograms a day, up from 64. The last increase that we announced was up to 160. So that's a huge increase, 356%. And what that really means for everybody out there is that the front end of the plant is able to handle that, but now we got to look at the back end of the plant because there's going to be increases in sizes and everything else, and that will entail further tests, more capital, and not a lot, but more capital to do that job. And but this is exciting work. I mean, we've always advanced on everything that we've done, and there's been a lot of news out there aside from ours that is exciting. Redwood Materials, which is one of the co-founders of Tesla, J.B. Strobel, put out a release, or not a release, I guess you'd say, an interview with the Wall Street Journal, and showed us stuff in Nevada. And, after looking through it all and everything else, I can see that it's a very sophisticated smelting operation. I don't know what their recoveries would be. I can only guess, but I wouldn't make that guess. It's certainly nothing like our recycling process, which is a closed loop and puts absolutely nothing back into the environment and gets all the cathode material out. So there's not a lot to compare there, but what I like about it is that J.B. Strobel is a high-profile person, and that's shone a spotlight on the recycling business, which we needed, and is to have somebody out there in production that can bring in the eyeballs, and certainly Benchmark Mineral Intelligence has put their shoulder to the wheel, because Simon Moore is considered the expert in batteries and EV cars and recycling, and now he's talking about recycling, which he did, had very little coverage on before. And what I like about it, he does say in there that the recycling that is going to go ahead is the cathode-to-cathode recycling, which is a metallurgical process. So I've talked about our permits as being very valuable, and I think that companies like Redwood Materials and everything else that we're trying to do, cathode-to-cathode sort of work, got stymied with the metallurgical process. But I see he's going to do a lot more R&D on that, and he's one of the first ones out there. If he goes public, that'll only be better for us because that means more news. A lot of people now will be trying to play catch-up on the recycling scene, and that's more news. The more they all put out, the more people that hear about it, and it's all better for the existing recycling companies. I can see that, this new attention is going to, grip us in the market, and that we could probably, in the next few weeks we'll be moving up steadily in the price range. So, again, that's exciting. It's just very, 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 very exciting. So, and I can't go the day without talking about the markets. I mean, geez, we took a heck of a hit yesterday. The Dow was down 800. The last I looked today, it was down, I think it was 150 or 300. I can't remember what time I looked at it. And, but it's, it looks like that slide, I believe, is eventually stopped. And, but that's very healthy for the market to have a correction like that, because it shakes out the weak holders and it gives an opportunity for stronger holders to come into the market, and that's always better for the market. So I see that this turnaround in the Dow will, if it doesn't happen today, it'll happen sometime next week. So, and it brings me up to gold, because in copper, which is, but gold's been taking hammers. It's up $7 so far today, but that doesn't. It's still It's still above 1900, and but it hit 2000. I think it went up to 2080 or something like that at one point. But a correction again in the gold market doesn't hurt. It makes a healthier market going ahead, because you're going to run into these corrections all the time. I think I've talked about it on my podcast, and I'm looking at the prices of copper, which is one of the dominant things in our spin out, and now it's at 308 or 306 the last I looked, and that's a 2-year high for it, and which excites me. What can I say, Jim? It's everything's pointing in the right direction, although it wouldn't appear to in the last couple of days. But I don't think that that's as longevity. That's going to turn around and go. And so, I'm looking forward to the next several months of activity. And I couldn't be more excited, Jim. It's I may not sound that excited, but that's because I always take a reclining position when I'm talking on the phone. So.
Larry, for people who are new to American Manganese, where are you traded, and how can people contact the company?
I'll answer that in a second, Jim, but I just wanted to mention again that Redwood Materials, it looks like they have a smelting. It looks like a sophisticated smelting operation using high heat of up to 2,700 degrees. So, I forgot to mention the degrees, and now I'll answer that question. American Manganese is traded on the Toronto Venture Exchange under the symbol AMY. It's traded in the U.S. under the symbol AMYZF. It's traded in Frankfurt under the symbol 2AM. You can do all the due diligence you need to do on our website. We've been very transparent about what we do. Because we're very excited about our circular economy approach, and you can also that's at AmericanManganeseInc.com, and you can phone us at the 778-574-4444. You can contact me at LREAUGH@AMYMN.com. And I wish everybody a great long weekend. I think September is going to be a great month.
Larry, thank you for the update.
You're welcome.
I've been speaking with Larry Reaugh, President and CEO of American Manganese. I'm Jim Goddard. Our conversation took place on September 4th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.